I'm Rahul Das, and today we are going to talk about IND AS 16 property, plant, and equipment. What are the objectives of IND AS 16? The objectives are prescribe accounting treatment for property, plant, and equipment, enable users to understand entities' investments in PPE, provide information about changes in such investments. The key issues in IND AS 16 are recognition of assets, determination of carrying amounts, depreciation charges, and impairment losses. Scope of IND AS 16 applies to all property, plant, and equipment except PPE classified as held for sale, biological assets related to agricultural activity except bearer plants, exploration and evaluation assets, mineral rights and reserves, oil, natural gas, etc. It applies to all bearer plants, applies to PPE used to develop, maintain excluded assets. Definition of PP: property, plant, and equipment are tangible assets that are held for use in production or supply of goods and services, are used for rental to others or administrative purposes, are expected to be used for more than one period, are not held for sale in normal course of business. Examples: land, building, plant and machinery, furniture, vehicles. What is the recognition criteria? An item of PPE shall be recognized as an asset when number one, there is a future economic benefits. That is, it is probable that future economic benefits will flow to the entity. Second, reliable measurement. The cost of an item can be measured reliably. Both conditions must be satisfied for recognition as an PPE. Initial measurement. What are the initial measurement? First, we take the cost component. Cost component includes purchase price, import duties and non-refundable taxes minus trade discounts and rebates. Then there are directly attributable costs such as site preparation cost, initial delivery and handling cost, installation and assembly cost, professional fees, employee benefit cost, etc., testing costs. Then there are additional cost elements such as borrowing costs, dismantling and restoration costs. Costs that are excluded from this cost components are opening a new facility, new product introduction cost, administration and general overheads, training cost, initial operating losses, abnormal wastage. There are subsequent measurement models. The entity must choose between one of these models for an entire class of PPE. Number one is the cost model, that is, cost minus accumulated depreciation minus impairment losses. Second is the revaluation model, fair value minus subsequent depreciation minus impairment losses. The revaluation requirements are basically very important and must be done with sufficient regularity. Entire class must be revalued, very important. Fair value must be reliably measurable. Revaluation accounting, how an accounting is done. When there is a revaluation increase, it should be recognized in other comprehensive income and must get accumulated in surplus, revaluation surplus or equity. Exception, reverse previous decrease in P&L. When there is a revaluation decrease, recognize in profit and loss. Exception, offset against existing revaluation surplus. Transfer to retained earnings on disposal of revalued asset. When there is a disposal of a revalued asset, it should be transferred to retained earnings. Even when the asset is used, gradual transfer is as asset, not through P&L. Okay. Then we have the component approach. The key principle is each significant component with different useful life must be depreciated separately. Identification criteria are cost component is significant relative to the total asset cost. Components has substantially different useful life. Component has different pattern of consumption. Examples: aircraft. An aircraft is made of airframe with an useful life of 20 years, whereas the engines are only measured for 8 years. Next is the building. Structure has a life of 30 years, whereas the roof has a life of only 15 years. Then we have the depreciation requirements. The key principle is systematic allocation over useful life, depreciable amount equal to cost minus residual value. Each component is depreciated separately. Methods are simple. straight line method, diminishing balance method, units of production method. And annual review is required for useful life estimation, residual value, depreciation method. Major inspection cost. And the treatment under IND AS 16 would be capitalize as a separate component, depreciate over a period until next major inspection, de-recognize previous inspection costs. Let us take an example of an aircraft only. The major inspection is done in every 4 years. Cost of 20 lakhs done is always capitalized, depreciated over 4 years. Previous inspection cost is always written off. Routine maintenance expenses as incurred should be booked. Now, bearer plants. What is a bearer plant? Living plant used in production, supply of agricultural produce, expected to bear produce for more than one period, remote likelihood of being sold as agricultural produce. Example, grapevines, fruit trees, tea bushes, rubber trees. Accounting treatment, treated as PP under IND AS 16, produce on bearer plants covered by IND AS 41, agriculture. De-recognition. When to de-recognize a PPE under IND AS 16? Number one, on disposal of an asset. When there is no, number two, when there is no future economic benefit expected. And how the gain loss is calculated on this de-recognition? Disposal proceeds minus carrying amount equal to gain or loss, whatever it is. The accounting that goes into derecognition is include gain loss in profit and loss account whenever derecognized. Gains not classified as revenue. If you remember, it should be classified as other comprehensive income under other income. Transfer any revaluation surplus to retained earnings. Key differences in between IND AS 16 and previously known accounting standard that is now replaced. First is the recognition criteria. There is a specific probability and measurement criteria in IND AS 16, whereas there is no recognition criteria in AS 10. Component approach. Indian 16 mandatorily signifies component approach, whereas AS 10 it was not required. Then the revaluation model. Both cost and revaluation models are allowed in IND AS 16, but in AS 10 only the cost model was permitted. Annual reviews. It is mandatory to review the useful life residual value for in IND AS 16, whereas periodic review was only done in AS 10. Major inspections must be capitalized in IND AS 16. Usually it is expensed when incurred in AS 10. Now the depreciation method. In IND AS 16, it is the estimated method that is and goes prospective, that is in the times to come. Whereas in AS 10, it was taken as a change in policy and it was applied retrospectively from the previous period. Okay. Disclosure requirements. For each class of PPE, disclose measurement based basis used, depreciation method and rates, useful lives, gross carrying amount and accumulated depreciation, reconciliation of carrying amounts, restrictions on title and pledged assets, expenditure on assets under reconstruction, contractual commitments for acquisition, compensation received for impaired loss assets. Okay. Now let us look at a practical example of component accounting. Of course, I've taken the simplest of examples. Suppose we purchase an aircraft for 40 crores. If you go by the traditional method, you will see that entire aircraft is depreciated over 15 years of time, and the annual depreciation comes to 2.67 CR or 2.67 crore. Under traditional method is simple. Entire 40 crores, we made that the useful life is only 15 years. So each year the depreciation, sorry, comes out to be 2.67 crores. But whereas as per IND AS 10, if we use the component method, you will see that airframe costs 24 crores, useful life is 20 years. Thus, annual depreciation comes to 1.2 crores. Similarly, engine 12 crores, useful life 8 years, annual depreciation 1.5 crores, and other components of an aircraft. Rupees 4 crores, estimated life it took 5 years, annual depreciation comes around 0.8 crores. So total annual depreciation is 3.5 crores, whereas under traditional method it was just 2.67 crores, taking aircraft as a whole. But in India 16 under component method that is made mandatory by MCA in 2025. The depreciation amount is 3.5 crores. So you can see there is a major impact, an impact of around 90 lakhs. Now let us take a practical example of revaluation. Very easy. A land which we bought at an original cost of 20 lakhs. We reevaluated it again through an expert and find out that what we bought for 2 crores, sorry, it was not 20 lakhs. What we bought for 2 crores, the value is now coming as 2 crores 30 lakhs. So the revaluation increases 30 lakhs. How would you do an accounting entry for that? Of course, when there is a revaluation surplus, you need to create an other income head, and under that other income head, you need to create a ledger such as revaluation surplus. The value of the land is increasing. It is not 2 crore anymore. It is 2 crore 30 lakhs. You have to increase the asset. Increase in asset is always a debit. So land account debit and revaluation surplus credit, as it is an other comprehensive income. As I have shown here also, surplus is shown in OCI, other comprehensive income and equity. Must reevaluate the entire class of land regularly. You need not reevaluate only a single part of the land. If there are other lands also in your balance sheet, you have to reevaluate that class as well. So the recent amendments and updates are 2025 MC amendments made us clear that enhanced disclosure requirements are necessary, alignment with global IFRS standards, clarifications on supplier finance arrangements, and the key focus areas in these are component accounting implementation that we just discussed, regular revaluation practices, useful life assessments, environmental restoration costs. Okay. What are the challenges in implementing this IND AS 16? Of course, the common issues are identifying significant components, determining fair values for revaluation, estimating useful lives accurately, allocating costs among components. And the best practices that can be accompanied are use engineering assessments, regular market valuations, document assumptions clearly, consistent application across periods. Conclusion. Oh, we we have come to the conclusion as well. India 16 brings significant improvements if done properly. Of course, it adds to the work such as the component accounting, where we need to really look at the price of different components. That is a real difficult task for any auditor, any chartered accountant, or any finance and accounts professional. But still, if implemented correctly, it has proved to be enhanced transparent and asset promote reporting, better alignment with economic reality, improved comparability and international standards, more accurate depreciation through component approach, which is a bit difficult, but it is more accurate. And the success to this implementations can be only if it is done properly. That is proper implementation and planning. Regular training and updates are very necessary. Strong internal controls. And last but not the least, professional judgment in estimates. That is, whatever judgment in estimates must be accurate or close about that. Thank you. So I hope you have got an idea of India 16. My purpose was to give you an idea, or you can say a basic understanding of India 16. With this only, major accounting methods or major accounting entries you can resolve at your end. Thanks to the MCA notifications, ICA educational materials, and IFRS foundation resources, which helped me make this a small informative slide. Thanks.